SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF Buffy Bocconi e-lecture on key takeaways from the ECB's new financial stability review. Under the shadow of geopolitical conflict, successive global economic shocks, weak euro area economic growth, and tightened financial conditions due to central banks' needs to bring inflation back to target, financial fragilities are looming. Sovereigns are facing substantially higher bond yields in markets to finance their sizable budget deficits. High credit costs are showing their effects on firms and households' debt service burden and in corporate and mortgage credit volumes. Euro area real estate markets are experiencing a downturn, and major property developers are coming into distress in several countries. Asset markets are adjusting to a scenario of high interest rates for a longer period of time, but may not have fully priced in a possible more market slowdown following from geopolitical tensions. Bank profitability benefits from the tailwinds of high interest margins, bolstering banks' equity buffers, but headwinds from a weak economy, deteriorating credit quality, and rising refinancing costs are growing. Non-bank financial firms have proven resilient, but face challenges both from cyclical and structural factors. In a longer view, the growing role of artificial intelligence and the prospect of a digital euro imply new needs and opportunities to adapt business models to a rapidly changing environment. Macroprudential overseers need to gauge the impact of these multiple factors and deepen and broaden the scope of their toolkit for bolstering financial sector resilience. Now, against this very, very complex environment, the ECB just released its latest FSR yesterday. We are privileged to have the ECB's leading mind behind the FSR with us today to present key findings. A warm welcome to John Fell, Deputy Director General, Macroprudential Policy and Financial Stability at the ECB, and also SUERF Fellow. John's presentation will be followed by comments and further inputs by two outstanding experts from the European Central Banking community. A heartfelt welcome to Benjamin Weigert, Director General, Financial Stability at the Deutsche Bundesbank, and to Clemens, Head of Division, Financial Stability and Macroprudential Supervision at the Österreichische Nationalbank. Without further ado, over to you, dear John.
Many thanks to you, Ernest, and to the SUERF board for inviting us once again to share the findings of our latest FSR with the SUERF community. 6 months ago, when we published our last FSR, you won't have forgotten that our main focus was on dissecting the stresses that had gripped US regional banks and which triggered blowback for a Swiss GSIB. Now, despite some turbulence in AT1 markets and a failed speculative attack on a German GSIB, Euro area banks largely weathered that storm. Resilience was tested, and once again, after COVID and the war in Ukraine, it was proven. Now, that doesn't mean that we were without our concerns. At that time, we viewed the combination of stretched valuations and thin market liquidity to be a recipe for market vulnerability, leaving asset prices exposed to the possibility of outsized reactions to negative shocks. Now, we were also starting to see just how robust the balance sheets of households, firms, and sovereigns, how robust they really were as they began to feel the impact of rising interest rates. And while Euro area banks had displayed resilience in the face of stresses elsewhere, challenges remained. Higher monetary policy rates were feeding through into bank funding costs, and with non-financial sectors also feeling the pinch of higher borrowing costs, we were seeing nascent signs of asset quality deterioration manifesting in an uptick in delinquencies, non-performing loans, and defaults on corporate bonds. Nascent signs, though. In other words, I think it was clear to see that the financial cycle had decisively moved into a contraction phase. Now, fast forward 6 months, going to the next slide, and if anything, the intervening developments have only served, I would say, to deepen our conviction that the financial stability outlook now is fragile. Broadly speaking, and I say broadly because we did have surprisingly low and market-moving US CPI figures last week, just before we finalized the proofs of our FSR, so it made it into the data. But market sentiment has gone through two phases since the early summer, so since the time of the last FSR. First, there was a period of excessive optimism, or we think it was excessive optimism about prospects for a soft landing of the global economy. A narrative, as you know, where disinflation would proceed sufficiently rapidly that it would allow central banks to make an early pivot and then avoid recession. There's a survey that Bank of America, Merrill Lynch carries out every month that asks a question about this, and it shows that sentiment about soft landing peaked in August, when there was an overwhelming 74% of respondents who thought either a soft or no landing was the most probable trajectory. Now, that widespread optimism seemingly acted as a counterbalance to the tightening of monetary policy. It had an impact on asset prices, even easing financial conditions in the US. Now, we considered that this narrative was at odds with the historical data. I mean, setting them up for disappointment. So one only had to look at, for example, Alan Blinder had a piece, an article in the Journal of Economic Perspectives earlier this year, where he scoreboarded 11 episodes of monetary policy tightening in the US since 1965, and he showed that only one of those episodes ended in a true soft landing. 2 got close, but 5 ended with hard landing. So those are the statistics. That's the historical data. Of course, each time is different. But all of it is to say that markets had, we thought, herded into pricing for an outcome that rarely happens. Then when US inflation started picking up, and with euro area inflation coming down maybe slower than markets would have hoped, the narrative started to change. 64% of respondents, so that's 10% lower than in August. In the October survey, were favoring a soft landing scenario. With that capitulation, the more adverse higher for longer scenario gained traction. You can see that there on the left, resulted in a rout in the bond market, and also the US stock market re-entered correction territory temporarily. Now, last week, the consensus actually changed after those CPI figures. So again, so it's safe to say, I think, that uncertainty around all of this, these two scenarios, is rising. And then with uncertainties, they've also been compounded by, of course, the flare-up of geopolitical tensions in the Middle East, which we're showing there on the right, and the effect on oil price volatility. Now, with that backdrop in mind, to go to the next slide, the rest of my presentation is organized around these 3 themes. First, a precarious combination of high valuations and low market liquidity, we think, renders asset prices vulnerable to adverse dynamics. We've said this before, I know. Second, rising debt service costs are posing challenges for all non-financial sectors. And third, while euro area banks have been enjoying a strong profitability rebound this year, asset quality and funding headwinds are starting to surface. Now, an important source of connection between these vulnerabilities, so these 3 different themes, and possibly reinforcement and amplification, is the speed of transmission of tighter monetary policy. And this is likely to prove key, we think, in determining the financial stability outlook, bearing in mind that there are both substitution and income effects of monetary policy. The substitution effects, so here I'm talking about the incentives to borrow versus the incentives to save. These are often visible earlier. We see this in the credit data, for example. On the other hand, the income effects, so that's the loss of discretionary purchasing power. As interest bills rise, as you roll over into a new and into a refinanced debt, those take longer, but could well prove to be more important for financial stability. They can be delayed by financial contracts, whether that's, for example, fixed or flexible terms in lending. But a higher for longer scenario, if it were to materialize, it's not the central scenario, by the way, but if it were to materialize, it could unearth several vulnerabilities simultaneously. Now, if we go to the next theme, and so that's why we can jump into the next one again, Jonas. Thanks. And notwithstanding the large losses that were endured by equity and bond investors last year, we still think that valuations are stretched. And with central banks no longer purchasing government bonds, market liquidity is eroding, and that's making asset prices more sensitive to negative news. Now, there are many ways to see the valuation stretch. One is to look at the usual price earnings ratios, these kinds of valuation metrics. But another way of looking at it is conditioning risk premia on the state of the economy. Now, ordinarily, equity market volatility is higher around business cycle turning points. You would expect that intuitively because that's when uncertainty is highest. But this is not what we've been seeing lately. The chart on the left splits the data for euro area equity market volatility, depending on whether the euro area PMI, so this is a proxy for the state of the economy, whether that's signaling expansion or contraction. And the position of the red dots on the bar in the middle, let's say the middle panel of that slide, the position of that red dot where the PMI is contracting, it shows that latest readings have been way out of sync compared to the past. So that's the interquartile range, is the box, the yellow box above. So outside the interquartile range and almost down at the very minimum that we've seen in the history. So among other factors, corporate bond spreads are driven by equity market volatility, and as you can see there on the right, unusually low volatility has kept spreads lower than we might ordinarily expect in the corporate bond market. So also conditioned on where the PMI is. Now we see all of this as being symptomatic of strong conviction in asset prices about soft landing prospects. But as I said earlier, and as the chart on the previous slide showed, capitulation may be taking place with markets pricing in a higher for longer scenario, or at least increasing the probability of a higher for longer scenario, which would, if it were to materialize, undoubtedly test these valuations. Now, going to the next slide and looking at market vulnerabilities in combination with known market-based finance vulnerabilities. So these are vulnerabilities that I've spoken about before in the presentations of the FSR. A particular area of concern we think at the moment is the corporate bond market, the euro area corporate bond market. And the reason for saying this is based on what we're seeing in gauges of investment fund run risk of the kind that we saw at the start of the pandemic. So here, of course, I mean, there's many factors play a role here, but the quality of the assets held by the funds matter. So does the ability of the funds, or what people know about the ability of the funds to meet redemption requests of end investors should they come and ask for their money back. Now, the chart on the left shows that the balance between, it's a slightly complicated chart, but it shows that the balance between the share of individual fixed income instruments, so this is done security by security, carrying positive rating outlooks against those that are carrying negative rating outlooks that are held in the bond portfolios of non-banks. So that's the green line. So it's a balance between those assets that are being downgraded versus those assets that are at risk of being downgraded versus those being upgraded. That green line, it has turned decisively pessimistic. So since most of the bonds that are now being held by the NBFI sector are at risk of being downgraded, ceteris paribus, that raises run risk for investment funds if we start getting lots of downgrades. Now, the question then is whether funds are holding sufficient liquid assets to avoid a situation where they're forced into selling assets should end investors behave pro-cyclically. And we know that they almost always do. They sell when prices are falling and look for the money back at a moment of market stress. Now, the chart on the right is making an attempt to gauge where there might be vulnerabilities by asset class. So we're comparing the high quality liquid asset holdings of funds which are specialized towards those particular asset classes, and then with estimates based on precedent, based on the data of the worst outflows that they could endure. Now, where the red dots are lying below those orange bars, it's maybe, I don't know, it's so easy to see, but where they are below, that's indicating that funds would struggle with a tail outflow scenario. So if you were to see worst case scenario, they wouldn't have enough liquidity, they would have to sell assets. Now, we see that this is the case for emerging market exposures, as you can see on the chart, investment grade bonds, but especially high yield bonds in the euro area. Now, given that I already said the valuations for many of these instruments look stretched, that would make the likelihood of a stress event in the corporate bond markets and the lower quality end of the corporate bond markets relatively high. Now, going to the next theme and starting with sovereign risk, there was always a concern, I think I've said it before, that higher interest rates could expose vulnerabilities in high debt countries. But we didn't see much evidence of market concerns until doubts about a soft landing scenario started to be priced in. The accepted narrative was that sovereigns had been opportunistic when interest rates were low. They locked in cheap financing and at longer maturities, and of course that would contain the vulnerabilities, but only for a time. With maturing public debt being rolled over at higher interest rates, sovereign interest payments have started to rise, and that's mainly in countries where short-term refinancing needs are higher. Now, issuance activity by sovereigns this year in primary markets has also remained relatively brisk. And at the same time, we have reduced Eurosystem asset purchases. There were concerns about whether or not whether those issuances would be absorbed smoothly by the market. So far, they have. And we think that this is largely thanks to higher interest rates raising the attractiveness of the asset class. Bonds were not so attractive when interest rates were very, very low, or even in some cases negative. Now you can get a decent rate of return on a government bond in the euro area. Still, fiscal fundamentals remain fragile in a number of countries where economic growth prospects are weak, where debt levels are high, and also where deficits remain high. Credit rating agencies have put a number of countries with those kinds of constellations of macro variables on negative watch. You can see there on the right. By the way, that is at the point of the cutoff of the FSR. We did have some changes in the outlooks after the FSR. But that wouldn't change anyway our assessment about the more medium-term risks. So far, sovereign spreads have remained contained. In fact, they're even lower than when the May FSR went to press. But still, with the possibility of interest rates remaining higher for longer, the costs, we think, of fiscal slippage when interest rates are high could be greater than when interest rates were low, just simply because of the arithmetic of debt sustainability. So sovereign debt sustainability concerns could be more easily reignited in a higher for longer scenario, compelling market participants to reprice sovereign risk. Now, if we go to the next slide and to the corporate sector, and we've observed an across-the-board collapse, for want of a better word, in the external financing of firms this year. Equity issuance had already slumped last year because, of course, the cost of this source of finance rose as we had those equity market corrections. But this year, new loan originations have contracted as well, and corporate bond issuance has also reduced basically to a trickle. And you can see overall, I mean, we're negative on the chart on the left overall. So notwithstanding then some evidence that banks with large unrealized losses on held to maturity fixed income portfolios, which came under focus more after the failures in the US, that has been impacting maybe marginally lending also in the euro area. But we interpret these dynamics as being mostly a reflection of a contraction of demand, credit demand for external funding, caused not only by higher interest rates, but also by the slowdown and the expected continuation of slowdown of activity in the euro area. Now, with a more pessimistic near-term outlook, then corporate sector expected default frequencies, they're there on the right, they have been pushed higher, and then with the impact unsurprisingly being larger as one goes down the credit quality spectrum. So you can see that there for the B/double Bs. We've had quite an increase in the expected default frequencies there. If we go to the next slide in property markets, these days I think one can hardly open a financial newspaper in Europe without finding an article about the ongoing adjustment to higher interest rates and weaker economic activity that is taking place in both residential and commercial property markets. Actually, yesterday, one of those stories was based on a special feature that was in this issue of the Financial Stability Review. However, we had thought the time was apt to dedicate some more space to this topic, especially because there are a lot of questions about it, and also questions about which of the markets, commercial or residential, poses the greatest threat to financial stability. Now, in housing markets, the pace of price decline has been relatively orderly so far. Now, I'm speaking for the euro area as a whole here now. And that's, you can point to some factors of resilience like robust labor markets, and also in some countries, supply shortages have been an issue which have, prevented housing prices from falling, or indeed are slowed it down. Now, we still see downside risks, and we see downside risks in the residential property markets for a number of reasons. First, and we have it in the FSO, our valuation models indicate that house prices remain stretched. It depends on which country you're looking at for the degree, but I mean, on average for the euro area as a whole, prices are still stretched. Second, debt servicing costs are of course rising, with the effects obviously being largest in those countries where flexible rate mortgages predominate. But of course, ultimately, in a higher for longer scenario, then households with fixed rate mortgages are going to feel the pinch when they come to the end of their fixed term, and then they have to, if they have to refinance, and then they're going to be paying higher interest rates as well. And then third, corporate profit margins have held up so far in the euro area, but profit growth is slowing. And if firms start taking the view that their viability is best preserved by shedding labor, I think we've had some evidence of hoarding of labor so far, but what has been orderly adjustment could prove could very quickly turn disorderly if we were to lose that resilience in the labor market. And then turning to commercial real estate, I think here one could say, but I said it I think before in this forum, this time really is different because the normal cyclical downturn that you would expect when you have a business cycle downturn is being amplified by well-known structural challenges affecting specifically the retail and the office segments of the market for reasons I think that are well known after COVID. So as a result, we have seen defaults on bonds issued by developers, and the market capitalization of euro area real estate firms has halved since late last year, as investors have priced in the impact of elevated financing costs and also falling profitability, while many believe that properties are too richly priced. And of course, they would be if you were expecting that you were going to fill an office building and now you found out that the number of people that will be going to the office is 50% lower. Now, could that be a source of systemic risk? And I think that this is a question on everybody's minds. Now, our answer is that a commercial property crisis would not be enough on its own to cause widespread capital depletion. And the reason for that is that bank exposures, while they are material, they're not large enough to cause a euro area financial crisis. As you can see there on the chart on the right, residential mortgage portfolios, for example, of euro area banks are much larger. Now, those are the averages, and we will have situations that are different. You can see the situations are different across countries, and they will also be different within countries. With, for example, maybe there will be some banks specialized in commercial real estate, and of course, those ones we would worry about. Now, going to the third and last theme, as recently as at the end of 2019, now just before the pandemic, low bank profitability in the euro area was high on our list of sources of financial stability concern. But this year, profitability, as I said at the beginning, it's been going from strength to strength. The reasons are well known. Average funding costs of banks have risen much more slowly than the yields banks have been able to earn on their assets. And that's specifically for the cost of deposits. Now, that has boosted net interest income margins of banks. And if you look to the pair of charts on the right, margins have increased more in countries where loans are contracted mostly on floating terms, and also where deposit betas have been low, and you kind of coincidence of both in some countries as well. But if you look then back again at the left chart, we have a conundrum. Bank profitability has on average doubled from the pre-pandemic levels that gave rise to financial stability concerns. But valuations of banks, if you look at price book ratios, remain hardly unchanged. They're range bound. And it's not shown there, but price earnings ratios, because of course earnings have gone up and stock prices have not gone up by as much. Price earnings ratios for banks have even fallen. So what's going on? Well, for one, if you scan to the top of the same chart, to the yellow line, the cost of equity for banks has risen by just as much as the return on equity, more or less. And that's partly due, of course, to higher risk-free rates, which raises required returns across the board. But the conundrum, our conundrum is, why is improved profitability not lower bank's equity risk premium? Because those profits allow banks to accumulate capital. The more capital you have, the less risky you are. And also non-performing loans are low, but the market is not pricing that in. Why not? So the next slide offers some explanations for this, what I would call an equity risk premium inertia. The main one being that neither bank analysts nor investors expect that this year's bumper profits are going to last, and they're projecting lower profits next year. Now, I already showed that firms' demand for loans has collapsed. So too has the loan demand of households, and that's either whether you look at consumer loans or whether you look at mortgages. And at the same time, we've seen a pickup in default rates on existing loans, both to households and to firms. So in a nutshell, revenues are set to decline and the cost of credit risk is rising. And then added to that, depending on how the economy performs, we expect that funding costs will rise over time, as well as competition amongst banks for deposits becomes more intense. Now, all of this is to say that investors are not convinced that euro area banks offer value opportunities, even though they are priced very low. And it can't be excluded that low bank profitability will make a comeback as a financial stability concern going down the road, given that a legacy of low for long is that many banks have been left holding low yielding assets with long maturities. So just think about mortgages that were extended during low for long at very, very low rates. Banks are going to have to finance those for years to come. So wrapping up on the next slide, our assessment is that the financial stability outlook has deteriorated. The financial cycle has unmistakably turned, and the severity of contraction, we think, will depend on whether the landing is a soft one or a hard one. Now, a particular challenge that we're confronted with at this juncture is that several vulnerabilities are unraveling simultaneously. Now, a financial stability is not complete without an evaluation of resilience. For every yin, there's a yang. And here we can, I think, derive a measure of reassurance. Our view is that the deliberate efforts that have been taken to fortify capital and liquidity buffers within the banking system have positioned it well to face those higher risks. We have already had those tests of resilience that I mentioned. Still, there is no room for complacency. And so, I mean, at a policy level, we're advocating for targeted macroprudential policy intervention where needed, really with the aim of safeguarding the enduring strength of this resilience through challenging times. So I'm going to stop there.
Thank you very much, John, for this illuminating and very interesting summary of key findings from the FSR. We're now very much looking forward to the comments. We start out with Benjamin Weigert. Benjamin, over to you.
First of all, let me thank John and the team for this excellent financial stability review. We also published our financial stability report just today, and I know from own experience how hard it is to write a financial stability review in a situation where permanently news arrive, and I think this year is not different from past years, where we have a ever-changing landscape of events that have direct implications for financial stability. And you will not be surprised to hear that we broadly agree with the overall assessment of the financial stability, given that the financial stability landscape in Europe and in the different member countries was more or less shaped by the low interest rate period before COVID. We all shared the COVID shock, so the same kind of shocks hit us, and the war in Ukraine also hit us simultaneously. So we are more or less exposed to the same shocks, unlike, for example, in the US, where they have a different impact from the war in Ukraine with a change in relative prices. So what shapes the financial stability situation is what John mentioned. It's the incredible fast change in interest rates. And I just want to show you, because this really highlights the dramatic change in the interest rate we've experienced during the past 1.5 years. This is just the distribution of interest rate changes, 12-month interest rate changes, and in terms of the low of the short-term rates, we are deep in the tails. So what we experience right now is basically a stress test of the entire system in real time, and this makes things pretty hard. And John alluded to that. So the question is, how will the financial sector digest the dramatic change in interest rates? And given that interest rate risks were highly prominent in the German financial system, we mentioned that since 2017-16 in our financial stability report, and even increased the countercyclical capital buffer and deployed other instruments to make sure that the financial system in Germany is resilient enough to withstand a change in interest rate. But no one had an interest rate change of that magnitude on its notes. And so this is really a dramatic change. When it comes to the situation for the banks, we broadened the perspective in our financial stability report a bit by not just looking at unrealized losses in the bond portfolio, but extended it to the loan book. And this is just, let's say, it's a way of trying to assess what the potential economic implications are if interest rates rise on the liability side. This is what John mentioned. So we look at the discounted value of the loan book, and you see here that savings banks and also credit cooperatives accumulated hidden unrealized losses, which may translate into actual lower profits, as John mentioned, if the liability side increases. And the liabilities, the interest rates on the liability side increase. This has not been the case yet. And this is, here you can see the components of the net interest income of German savings banks and credit cooperatives. And the blue bar in this chart is the contribution from interest margin deposits, which means paying deposit rates far below the market rate. So the contribution of not having increased the deposit rates according to the change in monetary policy rates provides them with a huge windfall, or at least a temporary. I wouldn't call it a windfall profit, but it's temporary. So once interest rates on the liability side increase, we will see that the interest income, the net interest income, will decline. And so this is something banks can use today to build up resilience. And this is therefore it's highly welcome that the ECB also pointed to keeping in resilience in the system and communicating that the dividend payout should be very prudent by the banks. This is probably a very temporary experience here. And why do we really think that it's temporary? If you just look at empirical models that try to assess what the deposit rate should be if you use historical data, then you see that the actual deposit rate is far below what we would have expected if we just use the empirical relationship of the past. It's not that much of a difference for time deposits, but for overnight deposits, it's a big difference. And once things normalize on that front, a huge chunk of the net of the interest income will decline. Second point I want to highlight is that given that we have a very low demand for credit, there is an intensifying competition among banks. And the question is, what's the implication of that? At least what we observe in Germany is that without a change in the probability of default of borrowers, that new loans granted to corporates seem to carry a lower risk premium. And this is what you see here. We try to calculate the spread on in new lending. It's one thing is risk-adjusted spread, the other is just compared to the same interest rate fixation period, but both point into the same direction. Since the change in interest rates, we see a decline in spreads, and this is something. It can be just the result of more intense competition among banks, simply because the demand collapsed in some parts of the market, or it can also be could be a sign of a more risk taking here, because they want to increase their average interest rate. A third point that is very special to, I would say, special to the German financial system is insurers. Insurers have the same issue as banks. They have unrealized losses, but unlike banks, they profit a little bit more because their liability side has even longer duration. So in terms of their capitalization, it's beneficial for them also in the medium term. But there is one issue in Germany with the surrender values. We have fixed surrender values. So if a policyholder wants to lapse its policy and wants a payout, this value is fixed and is not changed or adjusted for the change in the value of the insurer's portfolio. And this can result in something that is usually absent from insurers. So you wouldn't expect in the life insurer sector. You can have a kind of a run. I wouldn't stress that too much, but it points to a different thing, that we might see some kind of liquidity problem in the life insurance sector if too many people want to pay out from their life insurers. And also related to financial markets, the question is what will be the life insurers' reaction function in future market situations, for example, in stress periods where they usually acted in a counter-cyclical way, if most of their portfolio has unrealized losses. So portfolio rebalancing is costly in this case, and there is at least some likelihood that in future stress periods, life insurers are not stabilizing the market to the extent as they did it in the past. And partly you can see that since last year that the German life insurers were not as active on markets as in the past. Here you can see the turnover of German life insurers, so what they bought, what they sold, and it declined since last year with the change in the interest rate environment. With this, I would end my comment and will just thank John and his team for this great financial stability report and the very balanced policy messages that are not just correct but also helpful in this regard for the national macroprudential authorities. Thank you.
Thank you very much, Benjamin. We now turn to Clemens.
Thanks a lot from my side as well. So let me also start by really congratulating John on this FSR. I think, as always, I think it's both in terms of analytical insights, but also powerful and very true policy messages. I think it's again, I think a wonderful product. Personally, I always appreciate the insights from the market side, so the market intelligence side, because I think that's typically something for more resource constrained financial stability divisions like ourselves is always something where we can do less than we might want to do. Anyway, so we actually ourselves also, we published our financial stability report also this morning. We had the press conference between 10 and 12 today. So what I'm going to do is I'm going to run you very briefly through the main takeaways from our own financial stability review, which are fairly in line actually with what we have just heard. And then I sort of have a section where we tend to agree with the ECB on their assessment, and then we just some pointers for future work. It's not really disagreement or anything like that. It's more sort of what could we do from now, and where can we maybe put the focus in the coming months. So firstly, so the Austrian banking sector, as we've seen before, I mean, we're looking at profits at record high. On the left chart, you see, so the sort of full-bodied part of the chart is always the first half of the year, and then sort of the more dashed part is the second half. So you can see 2023, the profits of the first half of the year already exceed the pre-pandemic profits of 2018, 2019. So we're really looking at record high profits here. As also said before, I think also in Austria, I mean, the case you can see the green and the yellow line. The main reason is you can see the net interest margins went up tremendously, while the NPL ratios are still declining. Big question, as for everybody, is this going to last? I think our take is this definitely not going to last, at least not to that extent. Just to give you a few pointers on the with these four charts on the right, it's sort of, I think there are two perspectives. So obviously and John showed a few more slides on that, and Benjamin confirmed this for the German sector. I mean, obviously on the funding side, rates are going to go up. We've seen that the transmission, especially on the retail side, has been very slow, but it is going to pick up. You can see that on the left lower chart here, especially for the slightly longer maturities. We see, we really do see significant increases now, and are now above 3%, and we think sort of the shorter end of that of the yield curve will also pick up fairly soon. And then obviously on the asset side, you can see that also on the two charts on the very right. On the one side, we do expect that NPL ratios are going up. We see a slight increase actually on the CRE side already. If we look at some individual sectors, we also see some things moving. It's not a dramatic increase or anything like that, but the lines are starting to shift a little bit. And obviously the same and the same is happening as everywhere else. The loans to non-financial corporates are decreasing a lot, have been decreasing, and obviously with the funding going up, income side going down, I think profits will go down sooner or later. So that takes us to our recommendations. The Austrian banking sector is fairly well capitalized overall, but if you look at the largest banks, so if you compare the SIs with the other ones, we are a little bit on the lower end of the SSM distribution, which is why we strongly encourage the banks to strengthen the capital base by being careful on profit distributions, and then sort of the more standard things. So adhere to sustainable lending standards, provisioning for CRE. I mean, John also showed that. I think specifically, if you look a little bit at the collateralized part, I think if things continue as they have started to do, I think one could start to question a little bit some of the collateral, how much worth it really is if things go further down. and then obviously credit and interest rate risk in a challenging environment. Control for that is an obvious thing that keeps on coming back. So maybe turning to the ECB's FSR. So from our side, I mean, we really do expect that the cycle is starting to turn and that things are getting are going down a little bit. I also do realize that macroprudential authorities have been saying this for quite some time now, and it hasn't really happened yet. But I'm gonna give a bit of pointer on the next slide. But anyway, I mean, we do very much encourage the ECB's fairly clear language on that existing capital buffers should be maintained, and that it's not a time to release macroprudential buffers, but rather maintain them, and which is also what we are going to do. So our macroprudential measures will remain in place, at least for the time being. And obviously then the next part, I think the ECB has been also quite open on preserving the high level of resilience. Obviously something we agree with, which I just showed you in the slide before. And then something which if I'm not mistaken, is a little bit new. I think in the new FSR, borrower-based measures are called a structural backstop. For us, yeah, I think that's a great message to the outside world, because obviously many countries have gone forward in the low interest rate environment on borrower-based measures, which have at the time been very timely and because of strongly increasing systemic risk. But of course, even if things change a little bit, the idea that certain lending standards are kept in place, I think for us is a very useful and very correct and sound message. So I've said before that because I think the big elephant in the room is, I think macroprudential authorities and financial stability and so on, they've been warned about the cycle possibly turning. I mean, we've seen Corona, and actually the system has reacted very well. I mean, financial system went through that very well, even through increasing inflation, increasing rates. I mean, so far the system is actually fairly resilient. And then at some point the question is, so when is it going to turn? And I've actually done this small exercise. I'm sure I'm not the first one that has looked at this, but for me it was, who hasn't done this yet, I think it was actually quite an insightful thing to do. So if you look at the last time the ECB started increasing rates, was in December 2005, and then sort of 2.5 years out, Lehman Brothers collapsed. And obviously Lehman Brothers was really the big bang, but there were actually some things happening right before. And if you look, the latest hikes are roughly 1.5 years ago. So the ECB started hiking in July 2022. So that's 1.5 years. And actually, about in that time back then, first cracks started to appear. And I'm not in the forecasting business. I actually don't like to forecast anything, but I think it is interesting to look a little bit what has happened back then, what were the dynamics that went loose there, and compare it a little bit to back then. Because if we look at what has happened, I mean, we do see first cracks, right? So we have a weak macro financial environment. I think there's quite limited capacity, actually. I mean, inflation is still up, so there's not so much room for maneuver. We do see actually real estate market turbulences. I think in many countries, real estate prices are going down. I mean, in Austria, we have a fairly famous case, more in the CRE space, which has been in the news. So there are things happening. We are seeing first cracks. I mean, in Austria as well, there was actually a real estate fund has terminated its business just a couple of weeks ago. So, and obviously the more famous cases of SVB and Credit Suisse also could be considered. So there are sort of things where you think, okay, we are actually see first cracks, and maybe this time actually there is not we are not that far out. I mean, I think Benjamin also showed it. So everywhere you do actually see now these lines going up a little bit, which could indicate that we are actually at the start of a change. And I think on the points where we felt maybe even more could be done, or even more could also be pushed by the ECB here and there. So the first one, I mean, is obviously an easy one, and I think the language for for a product that has to go through so many rounds of consultation, I think it was actually fair. It would, I think, be nice to do even like more stronger language on the dividends distributions. But I also know from the COVID pandemic back then, if you get close to that type of questions, hell gets loose. Let's call it like that. So I also understand that this is a difficult part. I do think that on the liquidity risk, I mean, there's lots of focus on liquidity risk for non-banks in the FSR. I do think that also what happened to SVB and for instance, I do think that we shouldn't forget that the core, that there's maybe some concerns actually if obviously with more contractive monetary policy and so on. We shouldn't forget the core, and maybe we do actually have some time to fix some things there on the macroprudential side. Maybe looking at some runoff rates in the LCR and NSFR. So I think there are ways to do certain things, and maybe we should push there a little bit more. Same holds for macroprudential policy for CRE. And yeah, I mean, one thing I'm always wondering a little bit is I think the chart obviously I showed now was very simple, but with how things are transmitted in the system. But I mean, at least for us, I think more analytical work a little bit on trying to figure out, you know, with looking more deeper into maturity, looking more into loan books and so on, can we maybe get a little bit better guess of that? How long is that time actually until we see more happening? I think that there has been some very useful work, but that I think that is for me at least a big question in the coming months. How far are we out? It's a great report in these challenging times, and obviously very much appreciate the work itself and also the opportunity to discuss it here. Thanks.
Thank you very much, Clemens, for these insights on the Austrian Financial Stability Review, and also for your critical comments on the ECB's FSR. So let me first of all give John the opportunity to give some first reactions.
Well, look, I mean, they were both great presentations, and it's hard to say much about two guys that have just said that they agree with what we've written mostly. I think what Benjamin showed was really, yeah, very complimentary, and I think what it's showing also, of course, the specifics of a country where, you know, fixed rate lending is more important, and I think it's really helpful to show that. I think also what the work that you did on showing the pass through and, you know, how far away we are from where deposit rates should be. I think that's really helpful. I mean, one question that I'm always asking myself though, and I'm going to come back to it when I get to the dividend question that Clemens asked, is what do the banks, you know, do with the money? Is always the question, yeah, that's where I mean, I have maybe some questions there. Actually, maybe I just come to Clemens' point. I mean, I agree with everything that you said, and I think you will remember some discussions on dividend distributions. I mean, I think the point that I've always made, and it's not necessarily the house view. Actually, I think we debate this back and forth a lot, but stronger language on dividend distributions. I tend to think that we need to nuance it and say, look, we don't want you can get into situations, and also with distributions, I mean buybacks, you can get into situations where you have kind of strategic complementarities, where you have the weakest trying to compete with the strongest. So you've got some banks that are very well capitalized, and they want to distribute. Maybe they think that they have too much capital and they want to give some of it back to the shareholders. You know, this whole Modigliani Miller, you know, literature on that. You know, sometimes it's wise for the bank to give money back to the shareholders, because maybe the bank thinks that the shareholder might be able to get a better return out of investing those dividends than the bank can, because it's taking the view that actually it could be value destructive at the margin. And I think we saw some of that during low for long. So, but on the other hand, you know, then you've got weaker banks that maybe are also reliant on equity markets, and they're competing for capital with the stronger banks. And of course, then maybe they're tempted to also distribute. And you don't want those banks distributing, because those are the banks then that are going to cause, they're going to be the weak tail in your system. And so I think this is what we need to be careful, because, you know, valuations of banks, price book ratios below 1 are telling us that, you know, the market thinks that banks cannot get the money back, you know, that there's a better way of investing. And of course, and then also they lose they potentially lose long-term investors. You know, so those investors, the pension funds, the funds that rely on the, you know, banks are, you know, I always say they're not growth stocks, they're income stocks, and they generate income for pension funds and so on. And those pension funds rely on those dividends. And, you know, if they're not able to rely on those dividends, then they're going to stop investing in banks. So we don't want that. I think we want to have long-term investors in banks so that when banks go to the market, they will be able to, you know, raise equity capital at a reasonable price. So this is, so it's nuanced. And I think you were alluding to this difference in view, but I don't disagree. We should not be letting, you know, we should be avoiding that the weakest banks in the system are trying to pay out generous and eroding their capital base, because I think what we're saying here, and I think if I was to put words into the mouth of Clemens in terms of what he's saying, and I think it's what we're saying too, we're not out of the woods yet. I mean, we still have some adjustment to go through, and, you know, I mean, it could play out. Yeah, I mean, in a challenging way. It may not. We hope it may not. We may get the soft landing. It has higher probability, but, you know, we're going to have all of this pass through. There may already be weak, you know, accumulated losses in part of the financial system that we have not as much visibility on as we would like. And yeah, I mean, we could have, even though we're confident, I think, in the resilience of the banking system. We had the EBA stress test this year as well, which showed. Yeah, I mean, which included, by the way, a CRE stress that was more or less the same as what we've seen. That the banks, on average, are able to absorb that. But there are questions about the resilience of the non-bank parts of the financial system, and there, yeah, transparency is lower. We have had some episodes that have caused problems for banks, of course, as well. You know, Credit Suisse, I think, was part of the Credit Suisse story. So we want to avoid that. And I think this is something we didn't maybe talk so much about that in all of the presentations, but I think this is where maybe the weak link is. You know, the known unknowns are possibly there. But I think that's, I mean, I would agree with, if that's what you were saying, Clemens, that we're not out of the woods yet. We've got some years to go. And, you know, we've had a bigger increase in interest rates than we had before, as you showed in 2008, over a shorter period of time. And I think Benjamin is also showing the consequences of that across the whole portfolio of what banks are, the risks, the portfolios that banks are managing.
Thank you, John. We're actually at the end of our time, but I still cannot resist using a question from the chat for a very brief concluding round. And this question is very direct. It is, do you think we could expect a surge in non-performing loans in the near future, 6 months to 12 months? So just very brief answers by, I would suggest this order: Benjamin, Clemens, and then to conclude, John. Benjamin, what's your take?
Well, I'm fully aligned with John saying, and also with Clemens, we are not out of the woods, and we will see a structural surge in NPLs. I'm pretty confident that this will happen. I mean, the question is to what level. We already see this happening. That we have an increase, but it's still at a very low level. And a second thing that that makes things more concerning is that we have a structural challenge in the real economy, given that we've seen a change in relative prices, energy prices. So we not just have a cyclical adjustment here, but also structural adjustment, and both together at least point to whether it's a surge in NPLs, but much higher NPLs than we have experienced during the past years.
Thank you, Benjamin. Clemens, what's your take?
I've very little to add, actually. I would also agree. I mean, I also think we will definitely see an increase. I think we could be a little bit lucky on the sectors, because I think we've seen now certain sectors that already go slightly up. So if they are not too sort of, there's a tiny difference, maybe we just see a higher level, and then the composition of the sectors changes a little bit. Also depends a bit on the maturities, obviously, and for instance the intensity of energy and that type of thing. So I think we will definitely see an increase with a bit of luck. It's a bit distributed over sectors, and therefore.
Thank you very much. Last word for John.
So I agree with my colleagues. I mean, the only thing that I would say, it's almost by definition, well, NPLs cannot go and couldn't have gone any lower. You know, we actually, I think, managed, even though at the end of the last cycle it took some years to bring NPLs down. In the end, I think, I mean, some very good work was done on that, and so, you know, really the only direction that NPLs could go up. The question is how fast. I think there are some things that we maybe would still need to understand about all those supports that the corporate sectors in some countries had during COVID. Some of those supports still exist, and all of that. I mean, we had also the supports the banks were providing too. So the dynamics, the models, I think, are, you know, things may not play out exactly the way that our models would predict, because some of those empirical relationships have been affected by that. But nevertheless, I mean, you know, the intuition, the economics of what both of my colleagues said, I think is absolutely spot on. I mean, I think we will, for sure. And I think what Benjamin said too about the structural element. I mean, not to you know, discount the importance of that fact. I mean, some sectors maybe have been, you know, permanently, what is the right word, you know, permanently affected, let's say, by some of the challenges that we've been faced over the last few years from COVID on.
Thank you very much. This concludes our SUERF Buffy Bocconi e-lecture on key takeaways from the ECB's new financial stability review. A great thank you to John, Benjamin, and Clemens for your presentations and discussion, and to all of you for your interest and for your questions and comments. Bye-bye and take care.
Thanks.
Bye-bye. Thank you very much.
Thank you.
Bye.